I'm very much of the view that interest rates will remain at very, very low levels. They've been pegged at these ultra low levels now for about 7 years. And I think the authorities really want to hike rates, and it wouldn't surprise me to see modest hikes from both the Fed and the Bank of England in the next year. But I think the problem is that we've got this massive structural debt problem. And they know that the global economy is incredibly sensitive to changes in expectations on rates. And we saw that back in 2013 when US yields rose, and it immediately fed back into the US economy. So I think we'll see modest rate hikes in the next year. But I think they'll be very careful with the language around the hikes so as not to do too much damage to the markets. Well, I do think rates may rise a little bit this year, both in the US and the UK. I don't think it's going to do too much damage to the bond markets because to some degree it's been factored in already. The bond markets expect a modest hike in rates of about 0.5% in the US and maybe 0.25% in the UK. So that I don't think that would damage the markets too much. Well, historically, high-quality bonds have been great equity diversifiers. So investment-grade bond funds, for example, on average, historically, have had a correlation with equities of about 0. And I think that's going to be the case going forward. I think the real concern of some investors is that if rates rise, if yields rise, then bond prices may go down. I very much believe that we're in a slow-growth, low-inflation environment. I think yields are going to stay low, so I think bonds are okay. And I think the key thing about high-quality bonds is if growth disappoints on the downside, and that's when equities, may have a harder time. In that case, bond yields would fall, and there would be a good hedge against that poor equity performance. Well, a lot of people have talked about liquidity in corporate bond markets, and it's deteriorated ever since the credit crunch, really. And I was talking to our trader recently, and he expects it to deteriorate further in the next year. But there are some regulatory changes coming in, which is not helping liquidity. But further out, I think liquidity will improve. And there are various developments, tech developments, and developments with dark pools, which I think in the medium to longer run will help liquidity. So bond market's not very liquid. The way we deal with it is in several ways. We keep a good liquidity buffer in the funds. When we're investing in corporate bonds, we're taking a slightly longer term view on companies. And so, rather than taking, say, a 6-month view, we're taking a year, 18-month view, just on the basis that, it might not be easy to exit that position in a quick period of time. So there are things we do to mitigate. We ensure that we're getting paid for the illiquidity. But I think in the medium term, I do think liquidity will improve. Well, we've got this massive global structural debt problem, and I think with it comes a level of systemic risk. So think of it, the global economy is quite highly leveraged. That makes it very sensitive to changes in interest rate expectations. So I think there is this underlying systemic risk. The way I'm hedging that in the funds is focusing on high quality corporate bonds. So these are companies that even in the event of a systemic event like another credit crunch, these are companies that would come out the other side. So I'm very much focused on high quality secured bonds, on non-cyclical bonds, for example, regulated, or less cyclical bonds, for example, regulated utilities, consumer staples, food, drink, pharmaceuticals, tobacco, things like that. That's the way I'm hedging it. I do feel that corporate bonds offer good value at these levels. And so I'm pretty fully invested, but again, focused on the really high quality sectors and really shying away. I think there will be opportunities going forward, but currently not really involved in the cyclical sectors, the metals and mining, energy sectors.